Hello and welcome to Daily News Simplified, an answer to what, why, and how of newspaper reading. Today we are going to discuss The Hindu, dated 21st of September 2019. The index of the screen shows the articles that we are going to discuss today. The description of this video has a time stamping for the same. So let's begin. Now we have taken this article about corporate tax, which is covered on page number 1, and the editorial on page number 10 also talks about the similarly related topic. Now, as far as this topic is concerned, this again will come under economic development, and the subtopic would be Indian economy and the issues relating to planning, mobilization resources, growth, development, and employment. Let's begin. First thing that we need to understand is why it is in news. First and foremost, the Union Finance Minister has recently stated that government has brought Tax Law Amendment Ordinance 2019 to make certain amendments in the Income Tax Act of 1961 and the Finance Act 2019. This has been done in response to the present economic slowdown so as to provide corporate tax relief to corporate sector and promote greater amount of investment in the Indian economy. Now we need to understand what is the corporate tax regime in India. The corporate tax is a form of a direct tax to be paid by companies on their income. Now we need to understand companies act like entities and they are considered as individuals which can be sued. Second important aspect is that corporate tax is a direct tax. We know there are two types of taxes, direct taxes and indirect taxes. Incidence of direct taxes cannot be transferred. GST is an indirect tax. The corporate tax has been imposed under the Income Tax Act. Both domestic as well as foreign companies are liable to pay corporate tax in India. While a domestic company is taxed on universal income, foreign companies are liable for income earned in India. Now we need to understand what is a domestic company and what is a foreign company. Now domestic company is one which is registered under the Companies Act of India and also includes that company registered in foreign countries having control and management wholly in India. Our domestic companies include private as well as public companies. Foreign company, on another hand, is one which is not registered in India under the Companies Act and has control and management outside India. Now, as far as these companies are concerned, these companies earn profit or income, for which we need to understand how these companies earn income. Now, income of the companies come from basic element of profit earned from the business, capital gains, income from renting property, and income from other sources like dividend, interest, etc. So through this, we have understood what corporate tax in India is, what type of companies are there, and how companies earn income. Now we need to understand how companies currently pay taxes in India, especially the corporate tax. Now we need to understand how current scheme of corporate tax works in India. First and foremost, there is a type of companies. We have divided companies in domestic companies with annual turnover less than rupees 400 crore. Similarly, there are domestic companies with annual turnover more than 400 crores, and ultimately there are foreign companies. Now the surcharge is dependent upon the income that these companies generate. Suppose these companies generate an income of rupees 1 crore between rupees 10 crore, then the surcharge rates are different. And similarly, if surcharge rate on income greater than 10 crores are different. Cess is dependent upon corporate tax rate as well as surcharge. Now let's imagine a situation where a company earns a profit of say rupees 5 crore and it has an annual turnover of less than 400 crores. So this company will fall under the first category. The corporate tax rate will be 25% and the surcharge will be 7%. Now the cess, that is secondary and higher education cess that we are talking about, this will be charged on the combination of 25% plus 7%. So ultimately the cess will be 4% of the value, combined value of these two. And this is how the present corporate tax system works. In order to explain it again, let's assume that company is earning say rupees 50 crores in terms of income and the domestic turnover of the company is say 400 crores. In this case, the corporate tax rate is 30% and the surcharge in this case would be 12%, not 7%. And the cess will be calculated by the combination of these two, corporate tax rate plus the surcharge on net income which is greater than 10 crore. As already mentioned, we are talking about rupees 50 crore. So this is 4% of the combined value of this 30% plus 12%. This is the current scheme of corporate tax in India. In order to understand the government scheme, we need to focus on minimum alternate tax as well. Now let's understand this. Some of the companies in India used to show profits under Companies Act. However, the same companies show zero profit under Income Tax Act. So we need to understand the companies show profit under two major subheads. First is Companies Act and second is Income Tax Act. Companies like to show profit under Companies Act because this will actually encourage the shareholders. At the same time, they do not want to show much of income under Income Tax Act. And in this form, they basically avoid tax. So companies show profit under Companies Act, but they show zero profit under Income Tax Act. Companies take benefit of depreciations and deductions, etc., to ensure that they have no or very less income. In order to fight this behavior of the companies, government introduced the MAT so as to bring zero tax companies under the tax bracket. The MAT was levied at 18.5% of the book profits of the company, which is basically reflected under Companies Act. Every company is now expected to calculate its liability under Companies Act as well as Income Tax Act. And according to the provisions of MAT, the company has to pay whichever is higher of the two. So just to understand, income reported under Companies Act and income reported under Income Tax Act, the company has to pay whichever is. In this fashion, now we have understood about corporate tax in India, we have understood about the present structure of corporate tax rates, and we have understood minimum alternate tax. Now let's move towards the provisions which government announced yesterday. The corporate tax rate for all the domestic companies has been cut to 22% provided they do not avail any other exemptions. Now it is very important to understand when we say any other exemption. Suppose a company is located in an SEZ. So they are actually drawing some of the exemptions already. So these provisions will not be applicable for these companies. The effective tax rate for domestic companies will now be 25.7%. We have seen this already in the table, and this will include surcharge as well as cess. So the government has reduced the level to 22%, and once we add the surcharge and tax, it should not be higher than 25.7%. Second important aspect is boost to Make in India. Companies incorporated in India after 1st of October 2019 and beginning production by 31st March 2023 will enjoy even lower tax rate of just 15%. Again, the condition is same provided they do not avail any other incentives. The effective tax rate for these companies will be 17% only, and this will include surcharge and cess. Next important aspect is reduction in MAT from 18.5% to 15%. A company which does not opt for concessional tax regime and avail a tax exemption or incentive shall continue to pay tax at pre-amended rate. However, these companies can opt for concessional tax regime after the expiry of their tax holiday or exemption period. Further, in order to provide relief to companies which continue to avail exemptions or incentive, the rate of minimum alternate tax has been reduced from existing 18.5% to just 15%. Last but not the least, we need to understand rollback of buyback tax. The Union Budget 2019-20 has introduced 20% tax on the buyback of shares by companies. This had impacted the investor sentiment as buyback were a popular instrument with firms keen to give cash back to shareholders. The government has now decided to withdraw this tax. Now, the government has also decided to roll back the surcharge on capital gains. The Finance Act of 2019 has raised the surcharge on income tax from 15% to 25% for income in the range of rupees 2 to 5 crores and 15% to 37.7% for those earning more than 5 crores. In order to stabilize the flow of funds into the capital market, the government has declared that enhanced surcharge introduced by the Finance Act of 2019
shall not apply on capital gains arising on sale of equity shares. The enhanced surcharge shall also not apply to capital gains arising on the sale of any security, including derivatives, in the hands of foreign portfolio investors. However, with respect to other source of income such as salary, profession, or rent, etc., which is above rupees 2 crore, the surcharge increase will continue. Now, steps the government is trying to fight the economic downturn. Now, it will definitely be a boost to private sector investment in India. The investment GDP ratio in India has reduced from 34% in 2011 and 12 to just 29% in 2017 and 18. The government's move to reduce the corporate tax rates is set to give fillip to private sector investment and create employment opportunities and boost the economic growth and development. Second important aspect is boost to Make in India agenda of the government. The corporate tax rates in India was considered to be 50% higher as compared to other countries. And when we talk about other countries, we are talking about other Asian countries. This announcement of the government is expected to bring the corporate tax rate in India on par with the other countries and hence promote the amount of FDI into India, leading to a major boost to Make in India. This move comes at the right time as the MNCs are looking to shift their bases out of China amidst ongoing trade war with the USA. So this US-China war, the trade war, is also helping India in terms of inviting the foreign direct investment. Next important aspect is definitely the revenue loss and the fiscal deficit target. India will be losing around 1,45,000 crore rupees of revenue annually, and moreover it will also contribute to increase in fiscal deficit, which is not a very good sign for a developing country in India. It is expected that fiscal deficit would touch around 4% after these provisions are implemented. Last but not the least, it will definitely boost the capital market. The withdrawal of surcharge on capital gains arising from the sale of equity shares is expected to boost investor sentiment in the capital market. The Sensex has already posted its second biggest single day gain in more than a decade. So through these steps, it appears that the government is on the right path to improve the economic condition in India. GST is one of the most important topics that we have discussed in recent past, and page number 1 and 12 brings out an article which talks about GST Council meeting that happened yesterday. Now, as far as this topic is concerned, this again will fall under economic development and Indian economy and issues related to planning, mobilization of resources, growth, development, and employment. Now, as already mentioned, this topic has been very important, and we can see that in 2017, there was a question in the mains examination. Explain the salient feature of the Constitution 101st Amendment Act 2016. Do you think it is efficacious enough to remove cascading effect of tax and provide for common national market for goods and services? Now, you are expected to write an answer of 250 words, and this question was of 15 marks. Similarly, in prelims of 2018, we have seen a question which is related to GST. Consider the following items. First is cereal grain hulled, chicken eggs cooked. Third is fish processed and canned. And fourth is newspaper containing advertising material. Now we have to identify which of the following items are exempt under GST. So we know that third, that is fish processed and earned, is not part of it. And hence the correct answer is option C, that is 1, 2, and 4 only. Let's move to the article. Now, first and foremost, in its 37th meeting, the GST Council has announced a number of changes in the GST regime. In this regard, let us look into the important highlights of the announcement. But before that, let's understand basic things about GST Council. Now, first and foremost, GST Council is a constitutional body for making recommendations to the union and state government on issues related to goods and services tax. The GST Council is chaired by Union Finance Minister and other members of Union State Minister of Revenue or Finance and ministers in charge of finance or taxation of all the states. Every decision of the goods and services tax shall be taken by the majority of not less than 3/4 of the weighted votes of the members present and voting in accordance to the principles. As far as these principles are concerned, the vote of central government shall have the weightage of 1/3 of the total votes cast, and the votes of all state governments taken together shall have the weightage of 2/3 of the total votes cast. Now, in this meeting of GST Council, which happened yesterday, the 37th meeting, there were some recommendations, and we need to go through them. First and foremost, there is a reduction in GST rates. Now, some of the industries such as automobile and biscuit manufacturing were demanding cuts in the GST tax rates so as to boost the consumption expenditure. However, the GST Council decided to keep GST rates for these industries unchanged. Some of the important changes in the GST rates are as highlighted below. First and foremost, hospitality and tourism. To reduce the rates of GST on hotel accommodation for all those transaction values which are either less than or equal to 1000, the GST rates is 0 or nil. For transaction value for 1001 to rupees 7500, the GST value will be 12%. And for more than 7,500, the GST value would be 18%. The GST on outside catering is reduced from 18% to 5%, but without the input tax credit. Similarly, for job work service, the GST was reduced from 5% to 1.5% on supply of job work services in relation to diamonds. And the GST was reduced from 18% to 5% for job relating to engineering industry. As far as the payment of GST on storage and warehousing of certain agricultural products has been exempted. The important policy measures which are announced are: the GST Council has done away with the requirement of filing annual GST return for taxpayers up to rupees 2 crore turnover in order to reduce the compliance burden. Second is, the GST Council has given in principle approval to link Aadhaar with the registration of taxpayers under GST and examine the possibility of making Aadhaar mandatory for claiming refunds. But this is in principle approval. This has not been implemented right now. Suitable amendments in CGST or Central GST Act and Union Territory GST Act and the corresponding state GST Acts in view of creation of Union Territories of Jammu and Kashmir and Ladakh. New GST return system to be introduced from April 2020. Now you must know that it was earlier proposed that new system will come in place from October 2019. This has been done to give ample opportunity to taxpayers as well as the system to adopt to the new system. Let's move to the next article. We have taken this news from page number 15, which talks about firms can use CSR funds for R&D. Now, as far as this topic is concerned, this will come under economic development, and as far as subtopic is concerned, mobilization of resources, growth, development, and employment. Now, CSR as topic has always been very important from the UPSC perspective. In 2013, we have seen a question which talks about mandatory nature of CSR obligation and inclusive growth. In light of the importance of this topic, let's discuss this. Now we need to understand why it is important. The government has decided to expand the scope of corporate spend under corporate social responsibility norms. Through newly announced measures, corporate India can use their mandatory CSR spending for investment in public funded incubators and contribute to research in science, technology, medicine, and engineering at major institutions and bodies. So let's try to understand what is CSR and why CSR is important for India. India is the first country in the world to make corporate social responsibility mandatory following an amendment to the Companies Act of 2013, which was implemented from 1st of April 2014. Businesses can invest their profits in areas such as education, poverty, gender equality, and hunger as part of any CSR compliance. The inclusion of CSR is an attempt by the government to engage the businesses in the national development agenda. The details of corporate social responsibility is mentioned in section 135 of Companies Act of 2013. Now we need to understand the importance of CSR. Now CSR is important because companies grow and expand using public funds. They do definitely pay interest back to the banks or various agencies, but they do not contribute to public at large. Keeping this thing in mind, the CSR is made mandatory in India. As far as current regulation is concerned, every company, public limited or private limited, can either has a net worth of rupees 500 crore or more, or a turnover of rupees 1000 crore or more, or a net profit of rupees 5 crore or more, needs to spend at least 2% of its average net profit for the immediately preceding 3 financial years on corporate social responsibility activities. The CSR activities should not be undertaken in the normal course of business and must be with respect to any of the activities mentioned in Schedule 7 of the Act. Now let us understand the changes which are brought through government announcement. Till now, companies were allowed to provide CSR fund to technology incubators located within center-approved academic institutions. Now the government has widened the scope of CSR activities, and companies can now contribute towards research across various fields such as science, technology, and medicine. Besides, CSR funds can be spent on incubators funded by center or state or any state-owned companies. This is expected to attract more funds on research and development in the country. Now the companies can contribute to public funded universities, IITs, national laboratories, autonomous bodies, which would include ICAR, ICMR, CSIR, DRDO, and others. Now the point is to understand why is it important. It is important because India's current spending in the field of research and development is actually very less. It is less than 1%, or statistically, it is just 0.93%. Second important thing is there's a consistent increase in the CSR spending in India. In 2014, it was 10,066 crores, and in 2017 and 18, this reached 13,327 crores. So there are funds available, and there will be more companies in its lap as well. Out of over 21,300 companies which are expected to pay CSR, 10,800 have already complied. So we expect that in the time to come, more funds will be available for R&D. This is a very good initiative which will actually help in nation building. Now you may use this article for a mains practice question as well. In light of government's initiative to allow corporate India to use CSR spending on research and development, discuss how it would foster innovation ecosystem in India. You are expected to answer in 150 words, and this question is of 10 marks. Now let us take an article which is published on the page 10, and it talks about independent fiscal watchdog for parliament. Now as far as this topic is concerned, this will come under economic development and it will be part of government budgeting. Now as far as this article is concerned, this article highlights the role of parliamentary budget offices or PBOs, which have been set up in countries such as the USA, Canada, the UK, Australia, etc. These PBOs provide free, fair, unbiased, and independent assistance to the Parliament on all matters related to budgetary, fiscal, and economic matters. This in turn facilitates evidence-based discussion around important policies not only in the Parliament but also among the media and civil society organizations. In this regard, the topic argues in favor of creating similar bodies in India so as to strengthen parliamentary oversight over the government finances. Let's begin. Now let's first understand what is the need of fiscal watchdog or fiscal council in India. Now there is a major institutional gap in India's fiscal system. This gap has been recognized and identified by a number of committees such as the recent Finance Commissions and the FRBM Review Committee. International experience also points to the importance of such an institution. In order to overcome this gap, in many countries, a fiscal council has been set up. According to the chairman of 15th Finance Commission, N.K. Singh, has recently recommended setting up of institutional mechanism like a fiscal council to keep in check center's fiscal consolidation. In this regard, let us understand as to what fiscal council is and how the setting up of fiscal council can improve the credibility of fiscal policy in India. So let's begin with what is fiscal council. A fiscal council is an independent and non-partisan agency which is set up to publicly assess the government's fiscal performance against its stated objective. Fiscal council can serve both ex ante and ex post functions. Some of the functions that can be performed by fiscal councils include producing independent forecasts related to GDP, tax buoyancy, inflation rate, etc. It can also act as review to the government's forecasts and assumptions related to tax collection, fiscal deficit, GDP growth, etc. This is more of an ex ante function. It can also work for monitoring government's fiscal performance, including adherence to fiscal rules, and this can be an ex post function. Now, as far as this fiscal council is concerned, there is a lot of support from international experience as well. In recent years, an increasing number of advanced and some emerging economies are using independent fiscal council in order to enhance the credibility of their fiscal rules. International experience suggests that fiscal councils can improve fiscal outcomes and accuracy related to government's forecast related to fiscal parameters. For example, the United Kingdom has set up Office of Budgetary Responsibility in 2010 and granted it statutory status in 2011 to provide independent analysis of countries' public finance. On the similar lines, the USA has set up Congressional Budget Office in USA, which supports the budget making process by providing independent analysis of budgetary and economic issues. This highlights the need that India should also have a fiscal council. Since there is an international experience already which supports fiscal council and there is an emergent need as well, various committees like FRBM Review Committee headed by NK Singh and DK Srivastava Committee on Fiscal Statistics have already proposed to set up an independent fiscal council in India. The NK Singh Review Committee recommended that fiscal council should be an autonomous body and it should work under the Ministry of Finance as part of the Department of Economic Affairs. It is proposed that it should comprise of a chairperson and two members to be appointed by the central government. The persons to be appointed ought to have a significant experience in public finance, economics, or public affairs. Now, there is a strong support for fiscal council in India, which is done through international experience as well as the recommendation from committees. Now, let's understand what is the need. The general budget of the government is based on the forecast related to revenue collection and expenditure of the government for the upcoming financial year. Normally, it is found that government usually comes out with ambitious targets related to fiscal parameters such as tax collection, reduction in fiscal deficit, etc. However, the government fails to meet these ambitious targets, wherein there is wide margin between the budget forecast and actual targets met by the government. Hence, it is required to ensure that government sets realistic fiscal targets. Further in recent years, the government has resorted to off-budget financing. This is done in order to reduce its expenditure and to contain fiscal deficit. The CAG has raised concern with respect to off-budget financing since it understates the government's fiscal deficit and reduces accountability of the government to the parliament. Now, keeping this thing in mind, we need a fiscal council in India. Now, as far as fiscal council is concerned, what kind of a role it will perform? It can act as fiscal data coordinator. As a fiscal data coordinator, the fiscal council will have the responsibility of compiling and collating center, state, and local government fiscal data and provide individual and consolidated fiscal accounts of the government of India on a timely basis and make such data accessible to government and the public. It can also act as fiscal data analyst. It should utilize the compiled fiscal data to provide valuable insights into underlying fiscal trends and highlight their policy significance. It can also act as fiscal consolidation path monitor. The center as well as state governments follow their respective fiscal consolidation path according to targets set under the FRBM Acts. The Fiscal Council should monitor the compliance of these targets by the center and the state governments. It should highlight deviations in targets by publishing quarterly and annual reports. It can also act as fiscal policy advisor. Fiscal Council should provide guidance to the center and state governments on appropriate fiscal policy interventions aimed at improving growth and macro stabilization outcome. With this, let's move to the next article. Now we have taken this news from page number 9 from today's paper. This actually talks about a state-specific issue, but it actually highlights two important aspects. First, reverse tendering, and second, the location of the project, which is Polavaram. Now, keeping this thing in mind, this will fall under the geography, and it is important from the prelims perspective. We can see that Indian and world geography, physical, social, economic geography of India and the world, this is where this topic would fall. Now, as far as previous year questions are concerned, in the year 2019, you might have seen this question. What is common to the places known as Aliyar, Isapur, and Tangaspati? Now, we already know the answer to this question. The correct answer is option D. And we have seen that this question was there because these reservoirs came into news for various reasons in the last 1 year. Now, Keeping this thing in mind, this topic is again very important. Let's begin. Now, as already mentioned, the topic is related to reverse auction, but also to the Polavaram Dam. Let's discuss about Polavaram Dam first. Now, Polavaram project is under construction, multi-purpose national project on the river Godavari. Now, this project was accorded national project status, and this was given in the 12th five-year plan. Since it has been accorded the national project status, 90% of the funds are given by the central government and rest 10% by the state government. Now, as far as Polavaram Dam is concerned, Papikonda National Park is also situated nearby. And this Papikonda National Park is famous for Bengal tiger, leopard, and jungle cat. King cobra is also found in the Papikonda National Park. Now, it is also important to understand that Papikonda National Park has also been attributed the status of important bird and biodiversity area declared by BirdLife International Organization. Let us also understand the meaning of reverse auction. A reverse auction is a type of auction in which the traditional role of buyer and sellers are reversed. Thus, there is one buyer and many potential sellers. In ordinary auction, also known as forward auction, buyers compete to obtain goods or services by offering increasingly higher prices. In contrast, in reverse auction, the sellers compete to obtain businesses from the buyers, and price will typically decrease as the sellers underbid each other. Through the system, the Andhra Pradesh government has actually managed to save rupees 58 crores in the project. So this is something that is important as a concept, what is reverse auction, and similarly you have understood about Polavaram Dam, which is situated on the river Godavari. So this is important more from the perspective of the prelims examination.
Now, based on the discussion of today, let's attempt the practice questions. We'll take a pause of 5 seconds and then we'll discuss the questions. First question talks about which of the following taxes are direct taxes. Now, we discussed about minimum alternate tax and the correct answer is option A, that is 3 only. Second question is we have to consider the following statement. First statement is the government has introduced MAT so as to bring zero tax companies under tax bracket. And second is on comparing MAT with corporate tax, the companies are to pay the lower tax liability among the two. We already know that second statement is incorrect and first statement correct, and hence the correct answer is option A. Let's move to the next question. Consider the following statements. GST Council. First, it is an executive body, and second, every decision in the council is taken by simple majority. Both the statements are incorrect as it is not an executive body, it's a constitutional body, and every decision is not taken by simple majority. We take 3/4 of the total votes. So both the statements are incorrect and answer is D, neither one or two. Now let's move to the last question. Consider the following statement. The payment of the GST on storage and warehousing of certain agriculture products has been exempted. This is correct. The GST Council has done away with the requirement of filling annual GST returns for the taxpayer up to rupees 2 crore. Both are correct and hence the correct answer is option C. With this, we have come to the end of today's discussion. Let's move towards the question of the day.